guys, what's going on? Welcome back to another episode of Millennial Wealth. I am your host, Miguel, and I am here to guide you on our first $500 investment, guys. And $500 is just because it was kind of like accessible. You know, you can do that by mowing some neighbor's lawn. You can do it by delivering pizzas a few nights a week. Or maybe, you know, you save up your birthdays or whatever the case is. But of course, this works if you have $1,000, $10,000, $500, $200. It really doesn't matter. However, I would advise, even if you have a lot of money right now that you've been saving for a while, or you have a lot of money that you want to put into the market, I would always advise start very, very small, guys, until you have a deep understanding of the stock market, because the stock market is really not that complicated, right? After you learn to read a balance sheet and after you learn some like payout ratios and things like that, you're gonna know a lot more. So I just don't want you all to just jump in it and then maybe do some mistakes. But guys, before we start, make sure you guys drop a like down below. It's definitely gonna help my channel grow now that we're starting it. And if you have a friend that has been trying to dabble or has mentioned to you has any interest, or someone that you know could benefit a lot from this video, make sure you share it with them, because our goal here is really to change lives and just to, you know, build something, build some wealth, and maybe help us and help our future generations down the road, especially if you guys are young. I wish somebody would have shown me this video 20 years ago, because it would have been a massive difference in my life, guys. But today I have some very, very key concepts that everyone needs to know before you put even $1 in the stock market, guys. So let's get with it. First of all, when you're starting, guys, every single dollar you have counts, right? Everything you have, it has to be very, very important, and you have to treat them with a lot of care. So my number one lesson for you all is KISS. I don't know if you ever heard of it. It was a term that we use it a lot in engineering. It means keep it simple, stupid. A little bit harsh, right? But what that means is, guys, you never, and this is only doesn't have to be with stock investment. This can be to anything in life. Don't put money into anything you don't understand. Don't put money into something because I'm standing here telling you buy this, buy that. That's not how it works. If you don't understand something, keep your money away. You know, if your brother-in-law comes with this massive, oh, give me $1,000 and I'm gonna make it $2,000 in the next few months, like BitConnect. What's you know, you have to understand it. And I'm not telling you about, like, let's say I buy Tesla stocks. I don't understand how to build an electric motor. I don't know how their batteries work. I'm not telling you about that. I'm telling you about how their business works, right? Have at least some general understanding. Like when I first started picking stocks, like some of the ones I would choose would be things like Coca-Cola, right? Things like AT&T. Why? Because, well, I've been drinking Coca-Cola my whole life. I have a phone with AT&T that I've had my whole life, and I'm probably going to keep paying AT&T until I die because I need a phone at some point, right? So try to get things that are relatable to you. And those were just two examples that I'm giving out because I own shares in that. I own shares in Apple. Why? Because I have a MacBook, I have an iPad, I have an iPhone. Everyone in my family has it. Like, oh yes, I understand how they make their money, right? So keep that always in mind, right? I would advise right when you're starting, guys, to stay away from very, very speculative stocks, right? Stay with things that have a proven business model. Stay with companies that are making money right now. And even, yes, I own a bunch of shares of Tesla, but they are less than 3% of my portfolio, right? I owned a little bit of Uber, but it was like 2% of my portfolio. Why? Because, you know, Tesla now it is, but Uber was not a company that was generating revenue, right? So make sure that when you start, especially, that you are putting your money in companies that have a true history, companies that can produce money, and companies that can pay out some dividends, right? And then comment number 2, I'm saying numbers here, but there's really no numbers. Dividends are so important, guys, when you're starting. Why? Dividends was my motivation to keep putting money into the stock market. In case you guys don't know what dividends are, is my company is doing so good that I'm gonna give you a portion of my earnings, right? Let's say like since you gave me some money, you believe in my company, here you go, a little dividend paid back. They have a yielding anywhere from 0%, right? Companies don't pay dividend to whatever, 10%, 12%. And then there's something called a payout ratio, which is out of my proceeds, right? Out of my revenue, how much of that money I'm giving away. So always keep an eye on things like that, right? You don't want to be, because sometimes you're going to see companies that they pay like a 12% dividend, but then when you check, they're paying out 99, 110 10% of their earnings, meaning that that's not sustainable. That's not going to happen for a long time, and probably they're going to cut that dividend down. So those are things that you always have to keep in mind, guys. And if you don't know how to do it, if you go to like dividend.com and you put a ticker symbol, Apple, like every single stock has a name, right? Like Apple, and the ticker symbol is AAPL, right? So you put the ticker symbol right there. It's going to tell you what's the dividend, right? And in terms of money, what's the percentage and what's the payout ratio. And those are things that you guys have to definitely keep an eye on. Make sure you check the history. You know, have they been growing the dividend? Have they been lowering the dividend? Something like Triple M, right? You've seen the tape everywhere, right? But they do a lot of industrial stuff. They've been growing their dividend for 60 years, guys, right? It may not be big, but they keep growing it and growing and growing it. The odds are, if you buy it today, 30 years from now, they're going to still be increasing their dividend every year, just because, you know, they have a solid business and they just keep growing and growing and growing. Another one. Just because a stock price it's $3 doesn't mean the stock is cheap, right? The stock price, it's to me it's very irrelevant, right? Because stocks can do splits, right? Let's say right now Tesla hits $500 and they say, you know, that's a little bit high of a price, and we want to make sure that people with lower funds can go into it, and you know, anyone can buy it. Then they can do a split, meaning that for every one chair, now it's 2 chairs, and then they split the price in half. There's a bunch of companies do it. They also do a reverse split. Let's say like my company went from $10 to $1, which that's not great, and you don't want to be on that stock, let's put it that way. So then they say, well, every 10 shares is going to be 1 share. So it goes either of 2 ways. So don't just be oh, this is $3, it's so cheap, let's buy some. Ford, for example, Ford's a $10 stock, but that doesn't mean that it's cheaper. Well, in their case it is, but what I mean is, like, just because the price it's low doesn't mean that it's cheap or it's a bargain, or oh, I'm gonna buy this because it's gonna go from $10 to $11 and I'm gonna make a 10% profit. It's not gonna be that easy, guys. You have to check company valuation, you know, how much money they're bringing in, how much money it's going out, and relatively what you want to be looking at is the volume. You know, how many shares are out there and how much is this company worth, which it's the number of shares they have by whatever the price of the share is. That's the company valuation right now, in the billions, in the millions, or in the trillions if you are Amazon. And as a fun fact here, there's a company called Berkshire Hathaway, right? I don't know if you guys have heard of the Miracle of Omaha, Mr. Warren Buffett. He has its own fund, and he has 2, Berkshire Hathaway A and B. A, the stock, he's never split it. So if you want to buy 1 share of that stock, it's $340,000. But that's an index, right? That's not like he doesn't have a company. He has an index fund. I can go into in-depth in that later if you guys want. Okay, this is very, very important. Last year in the stock market, 2019, was a massively hot market. A lot of people like to say that the stock market in 2019 went up 30%. A little bit misleading, right? Because you're just taking like the actual physical calendar. Like 2019, they went up 30%, but right before 2019 started, at the end of 2018, the stock market dipped a lot. So, you know, don't take relative dates like that. They usually don't mean a lot, but yeah, the stock market came up a lot in 2019 in general. And my next point is, guys, don't be emotional, right? Stocks go up, stocks go down, stocks go sideways. It's gonna happen. But don't make the massive mistake of buying high and selling low just because you didn't have the stomach for it, right? Before you put any money into a company, you have researched this company. You believe in the company. You think they're doing good. You see that they're increasing their revenue. You see that they're profitable. You see that everything's going. If a crash happens, and a crash will happen, right? Me, I'm 32 years old right now, and I'm going to retire when I'm 60. The stock market's going to crash 3, 4, 5 times before I retire, right? But for me, that I have a super long output, right? A super long, like I'm not going to sell my stocks for the next 30, 20 years, 40 years, right? So what's happening right now doesn't really concern me that much, because yes, it's going to crash. Yes, it's also going to go up, right? We have over 100 years of history, and eventually, you know, it always goes up, right? Like it's, if you do a chart, you're always going to see that it's still going to keep going up. So don't panic sell, but at the same time, if you bought a company and you see that something has changed with the fundamentals of the company, let's say Coca-Cola, right? If Coca-Cola says an announcement tomorrow that, you know what, we're not going to be selling any more sugary drinks, we're going to move away from that, we're only going to sell water. and we're going to sell, I don't know, I want to say something really ridiculous, but just to illustrate a point, we're going to start selling window cleaners and bottles of water. It's like, that's a very radical change for what I'd sign up for. And at that point, you may sell, and that's fine, right? But as long as your companies are fine, don't panic sell, right? If a crash happens tomorrow, you can have a strongest company right now, I don't know, Amazon, Apple, Google, whatever, and their price will go down because the stock market is going down. But that doesn't mean that the company is necessarily doing bad, right? It's just mean that the stock market's going down. That's what the market does. It goes up, it goes down, but over long periods of time, it mostly goes up. And that's one of the things that you have to keep in mind. So don't sell at a loss unless you're doing it because something has changed with the company, or because you need some money or whatever. That's why you want to invest what you have. Like, you want to budget, you want to make sure you have a little emergency fund, because you don't want a big emergency to happen. The AC goes down, your car breaks down, and then you have to sell some stocks at a loss because you have to pay for that. So keep that in mind, please. One of the most important things that a lot of people will glance at and won't tell you is that everyone is like, oh, just put money into the stock market. Don't worry about it. Just put money into the stock market. And I would advise you that you're watching right now, if you have credit card debt, if you had high paying loans, if you have student loans with high interest rates, you have to work on getting out of debt as soon as possible, guys, because the faster you get out of debt, the more of your revenue, right? The most of your salary, of your money, of your work you can put towards investing, right? Don't FOMO in, right? Don't be like, oh my goodness, Tesla is going to go to $1,000 tomorrow, I heard. So let me just put all my money in it, because sometimes it won't happen, right? Sometimes it will go slowly. And when you have a credit card that is charging you 10, 15, 20, 25% interest rate, it's not worth it. So I think this is one of the main points that all the investment channels like always glance, and they don't never touch it. I've never heard an investing channel say don't buy stocks until you're out of debt. So that's why I'm here to tell you guys, please make sure you're out of debt, at least high interest rate debt, right? If you have a car, I paid off my cars, right? But if you have like a house, it's fine, whatever. The house, it's gonna take a while to pay it off, but big interest rate things, get out of them, because then you can just allocate so much money out of there. Okay, last thing is, guys, don't be greedy, right? Have you guys seen the show Deal or Not Deal? That show has taught me more in life than a lot of my school has. In case you guys are not familiar with the show, there's like, I don't know, 40 briefcase, and you pick one, and then they have anywhere from $1 to $1 million, and you keep opening them. And at the end when there's only 4 chests for a briefcase, there's gonna be one that has $1 million maybe, and then one that $1, and they say, oh, we'll give you $200,000 if you end the game here. And the person, no, I'll go for the $1 million. And the people most often will end up walking away with $1. Don't be greedy, guys. I'm not very greedy when it comes to the stock market. I bought a bunch of Tesla and I sold it because I made 25% profits in 2 weeks. You know what? I'm happy with that. I don't need it to skyrocket. I don't know that I'm ever hold a stock that has like 3, 4, 5x, because I won't hold it for that much. And a lot of people will disagree here with me, but I'm just conservative, right? I'd rather just get my profits and put them into something else that's going to pay me dividends for the rest of my life. And I did good and I move on. Same thing with Uber. I bought Uber at $26. Uber went to $35. See ya, Uber. Thank you, Uber, for the profits. Very cool. And if Uber goes tomorrow to 50, 60, 70 bucks, I'm not going to lose sleep over it, because profits are profits. I made my profits and I'm happy with them. So I think that's also something very controversial. I mean, there's stocks that I'm going to hold for the rest of my life. I'm not selling my Apple. I'm not selling my Microsoft stocks, guys. I'm not selling Amazon. I'm not selling Google. There's stocks that I love and I'm going to have for the rest of my life. But there's other stocks that's fine. We made a quick profit on it. See ya, wouldn't want to be ya. Okay, so there's 11 sectors that the stock market has, and I'm going to read them to you right now just so we know. Energy, materials, industrial, consumer discretionary, consumer staples, healthcare, financial, information technology, IT, telecommunication services, utilities, and I don't have another finger, but real estate. Use my head as a finger. Sometimes you want to diversify, right? You may not want to put all of your stocks into the IT. If you have a portfolio that it's only Microsoft and Apple, and something really bad happened to IT, and you have all of your eggs in a basket, it's just not going to work out for you. So diversification, especially at the beginning and at the end, at every point in your life, it's good, but don't diversify just for the sake of diversifying. Like I don't have 9% out of each industrial, but I don't have 50% in any industrials, right? So don't just do a checklist. Yes, I have this, I have this, I have this for the sake of having it, because it's not the most important thing at the end of the day. But let's say there's real estate, right? You don't want to have all of your holdings in real estate and then the real estate market crashes and boop, there goes your portfolio. So, at least try to have a few of them, and I think you're going to be fine in the end. So now, if today, and I put a lot of thought into this, if somebody gave me $500 and tell me, make me a portfolio, and by the way, make sure you guys are reading the companies, and they call that DD, the due diligences. Make sure you guys are doing your reading, make sure you guys are doing your stuff, because this is just me making this video so my son can watch them one day when he's 18. So if you get some benefit out of them, good. If I had to put today a stock portfolio for my 3-year-old son, this is what I would do with $500. The first one I would buy would be the SPY, Standards and Poor's. It's just an index of the S&P 500, right? And the S&P 500, as the name implies, it has 505 companies, right? So every dollar you put into that, and it's $325 right now. By the way, some brokers allow you to buy fractional shares, so you can buy like 1/10 of a share or 1/100th or whatever they do. But this is just whole 100% one share of thing. So just buying one share of the SPY, there's other, by the way. Vanguard has their own, Fidelity has their own. Like SPY is one that I like because it has a lot of liquidity. So just buying that one share for $325, you're gonna own a piece of 505 companies. And it's not divided like a dollar. Like let's say, $1 doesn't get divided into 505 equal parts. It's by weight, right? And their biggest holdings, and I'm gonna tell you right now, it's Apple, Microsoft, Amazon, Facebook, Berkshire Hathaway, which is the one we mentioned earlier, JP Morgan Chase, Alphabet, which is Google, Johnson & Johnson, Visa, and Procter & Gamble. So those are the 10 biggest holdings in there. But I'm not gonna read the other 495, but there's only 495 companies. So just buying this SPY, right, the S&P 500, you already own a piece of those companies. And there's a lot of other companies that you probably will know, and I'll put them somewhere here so you guys can see them. Number 2, T. Ticker symbol T, AT&T, guys. I love AT&T. Why? Because I cannot get rid of AT&T or Verizon, right? If you guys like Verizon, I wouldn't buy Sprint or T-Mobile. But either of those two, either Verizon or AT&T, I love them. Why? 5G's coming. People are gonna pay cell phones every single month, guys. I think like before it was a commodity, but now it's mostly a necessity. So those are things that are not gonna go away, period. AT&T has a dividend that I like a lot, which is $2.08. They get paid quarterly, so they divide that between 4, so you get about 50 cents per share every quarter, so every 3 months. And that's a 5.39% yielding, and I like that a lot. I would buy one share of Bank of America. I had Bank of America for the last 10 years, and I know that people hate it. I don't have a problem with them. They do everything I want, and I don't pay fees because I read it and I know what to do. Their dividend is not great, right? It's only 2%, which comes down at 72 cents per share. But I think the stock's gonna go up in the long term. I think they have a lot of things going for them in the future, so that's a stock that I like. Number 4 would be KHC, Kraft Foods. Dude, who doesn't like Kraft macaroni and cheese? If you go right now to your kitchen, right, provided that you are in the US or whatever countries they service, most likely you're gonna have 15 things from Kraft Heinz. Ketchup, right? Heinz ketchup. Who doesn't buy Heinz ketchup? Stock is down a lot since they got there, since they were an IPO a few years ago. And right now it's at $31, and they pay a $1.60 or 5.21% in dividend. I think they're gonna go up as well, and I kind of like them. Then we have Coca-Cola. Guys, who doesn't drink Coca-Cola? We could have the biggest recession in the world tomorrow, and people are going to still drink Coca-Cola and smoke cigarettes, right? So those are two things that I like because they're recession-proof. No matter what happens, those are two things that are always going to sell. Coca-Cola has a pretty cool dividend of $1.60, coming in at $2.88% dividend yield, and they're going to keep increasing it, period, right? I mean, It's just what they do. So now I have two that this were one of the biggest motivators for me to invest. And you can choose, and this is me choosing, right? There is this company called Gladstone. They're like a conglomerate, and they do a lot of things: investment in real estate, investment in financial investment, lending money to companies. But one of the things they do is they pay monthly dividends, and there's no different at the end of the year when it comes to monthly or quarterly. They're gonna give you whatever the dividend yield is. But I like two in particular. It would be either one share of good, which is like the real estate REIT. REIT is a real estate investment trust, which is like let's say I give you $100,000, right? You buy a house, you rent that house, and you give me a portion of the profits, right? Usually in real estate, you make about 18% because the houses go up in value, the properties, whatever they are, and then you have tenants, right? I don't want to deal with tenants. I don't want to deal with people. I don't want to deal with owning property. So I like REITs a lot. And REITs are by law required to pay out 90% of their profits in dividends. So they have really, really high dividend yields. So good is one that I like. They pay every single month, guys. So one share of good, it's going to give you about 12 cents every month. I know it's $22, still pretty good. And their dividend yield is 6.95, but I think it's going to go down because they haven't been doing that good. The other one is Gain, right? It's also from Gladstone, but that's one that it's a financial, not a REIT, but they also pay out a very, very hefty dividend of 82 cents. The share price is $13 and the dividend yield is 6.18. So if I, Miguel, had to do a stock portfolio for my son today and just leave it there, right, and continue to add to it, that's the portfolio that I feel I would put out for him. $500 will get you all of that, and every year you're just gonna get those sweet, sweet dividends, guys, and the compounding potential that you have, it's just infinite. A lot of those companies will continue to go up and up in price. I don't see any of them going out of business anytime soon, and I just like them. And again, your biggest holding in that portfolio by a lot is going to be SPY, which you have 505 companies. So odds are you're going to be doing good, guys. And if you don't want to do the research, if you guys don't care at all about reading stocks and picking stocks and whatnot, just put everything in SPY. Just put everything on an index fund and just wait it out, guys. We have over 100 years of data suggesting that, market's going to do good. So at least that's my methodology, guys. If you agree or disagree, or if you have some points, let me know down below so I can improve upon my content and I can improve upon my opinions, right? We don't know everything, and we don't know what we don't know until we learn it. So that's what we're here for. I'm going to be documenting my whole journey throughout this wealth building. And I think one of my future videos is going to be disclosing one of my biggest portfolios that right now has about $106,000 in it, and just show you what I have, why I have it, and how much it's been growing every month, and showing you those sweet, sweet dividends that it produces. But anyway, guys, I'm gonna wrap it up for this video right now, guys. Let me know down in the comments, what can I do better? What did you like? What did you not like? And if you agree with any of what I said, or if you think everything I said was a complete waste of everyone's time. Hopefully it wasn't. But anyway, guys, thank you all for watching. I hope everyone's having a fantastic time, a fantastic day, and I'll catch you all later. Bye.